AMC didn't just raise another $200 million. The company has now accumulated $350 million in fresh capital over the last 90 days, and that single number is changing how investors are evaluating AMC's financial position. So why is the stock still trading around $1.89? And why are some valuation models now placing fair value above the current market price? That's exactly what we're breaking down today. If you enjoy fast, data-driven stock analysis without the hype, make sure you're subscribed. We cover the biggest market-moving stories every day so you don't miss the next major catalyst. Now let's get into what Wall Street is actually looking at. Over the past 3 months, AMC completed 2 major financing transactions. The company first raised approximately $150 million through its at-the-market equity program, then followed it with a $200 million direct institutional placement. Together, those transactions brought in roughly $350 million of new capital. At first, most headlines focused on one word: dilution. And that's understandable. Whenever a company issues new shares, investors immediately worry about existing ownership being reduced. But now that the financing has been completed, many analysts are shifting their attention to a different question. What does AMC's balance sheet actually look like after these transactions? That question is becoming increasingly important because AMC has already used part of that capital to strengthen its financial position. Earlier this year, the company retired approximately $125 million of debt that was due in 2027. That move permanently reduces annual cash interest expense by roughly $7.7 million, while removing one of the company's nearest significant debt maturities. For a business that spent years trying to improve its financial flexibility, that's a meaningful change. Instead of preparing for a major debt repayment in the near future, AMC now has additional room to focus on operations and investment. And that's where the rest of the cash becomes important. Management has previously discussed investing in higher return projects across its theater network, including expanded premium seating, upgraded auditoriums, and enhanced large-format experiences. Those projects aren't simply cosmetic. They're designed to increase revenue generated from each individual customer. And recent industry trends suggest that strategy may already be working. While overall movie attendance remains below pre-pandemic highs, spending per guest has continued increasing. Premium experiences such as IMAX, Dolby Cinema, laser projection, and AMC's proprietary premium large-format screens are generating stronger revenue per ticket than traditional screenings. At the same time, food and beverage sales continue contributing higher margin revenue. That means AMC doesn't necessarily need record attendance to improve profitability. If each guest spends more during every visit, revenue and margins can improve even without fully recovering historical traffic levels. That's an important shift many investors are now paying attention to. There's another development worth discussing. Following the completion of AMC's latest financing, some equity valuation models have updated their estimates. One widely followed model now places estimated fair value near $2.16 per share, compared with a recent market price around $1.89. Of course, valuation models are not guarantees. Different analysts use different assumptions, and market prices can remain above or below estimated fair value for long periods. But the update suggests that at least some analysts are beginning to evaluate AMC less as a distressed company and more as a business undergoing a financial turnaround. Whether the broader market reaches the same conclusion remains to be seen. For now, investors appear divided. Some continue focusing on the additional shares issued during the recent financing. Others believe the stronger balance sheet, lower interest costs, and investment in premium experiences have significantly improved AMC's long-term outlook. That disagreement is exactly why the stock remains one of the market's most closely watched turnaround stories. The next major catalyst will likely come as investors evaluate upcoming operating results and determine whether those theater upgrades and higher margin customer spending begin translating into stronger financial performance. If they do, the conversation surrounding AMC could continue shifting away from survival and toward sustainable profitability. And that's a very different discussion than investors were having just a few years ago. As always, remember that no single metric guarantees future stock performance. AMC still faces execution risks, changing consumer behavior, and broader market conditions. But the numbers released over the past few weeks suggest the company's financial position is evolving, and that's why so many investors will be watching the next earnings report and operational updates closely. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications. We'll continue breaking down the biggest AMC developments as soon as they happen so you can stay ahead of the headlines.